Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another Planning for Life podcast. Today, we are going to talk to Russell Jacobs, certified financial planning professional, about the 8 basic principles of financial planning. I highly recommend that if you're not driving right now that you take some paper out, because Russell's going to go through a bunch of things here that are very important for you to consider when you're working with a financial professional, especially if you are not working with a certified financial planning professional. And these could be reasons why you want to make the switch. So Russell, welcome to the show.
Thank you, Matt.
All right. So these are 8 really good principles. We talked about it before we started recording, and you said, yeah, these are really in line with what we do here. So let's talk about, let's just start with number 1.
All right. Well, number 1, investing in happiness should be your top priority. And if you think about it, many people go through life not happy because they never, for whatever reason, feel confident enough or comfortable enough to pursue either their dream or what makes them happy. And of course, you have to put some caveats around that because, it's not all rainbows and sunshine. Sometimes you have to deal with unpleasant requirements, but it's really about knowing what you want, so because financial planning with us and the rich planning experience is about really working with clients to sometimes assist them to determine what it is they want, or in this case, what makes them happy, whether it be when they want to retire, they want to save money for a new car, big vacation, so their child can go to a certain college. You have to identify the metrics so we can determine what it takes to get what they want and what will make them happy. And then they can make an educated decision as to whether they want to pay that price or not, because everything has a price to be able to accomplish that achievement. And so that's really what the planning process is about. What does it take to get you where you want to go and stay there? Because it's also about doing it in a sustainable way and understanding all the dynamics that are involved.
I love that you brought this back to the Rich Process. And if you have not listened to the Rich Process podcast, make sure you go back and listen to that because Russell goes through each of the steps, and we're going to be highlighting a lot of those today. Okay, so number 1 is investing in your overall happiness, making sure that you're doing the things that you want to do and planning for those in retirement. What's number 2?
Number 2 is risk and return, and a lot of times people want to be safe because they're scared of risk. But on the flip side, if you're too safe, you can actually create more risk for yourself because you can't overcome inflation, taxes, and other expenses of life. So it's about really understanding your risk tolerance and creating an appropriate portfolio for your time horizon and your goals and objectives, which we spend a lot of time determining what are they and are they realistic, or do you need to adjust your dreams? But then you have to understand if you want to get higher returns, you're going to introduce more volatility. I call it bounce factor, more up and down in your portfolio, but that can be fine if you have the right timeline, because you can't have an up without a down per se. And over time, the stock market has really been the place to be, but you want to have other things in your portfolio as well. And make sure that you adjudicate that. And then as time passes and you are older, have different circumstances, you adjust your risk and return metrics along the way. So it's really about determining where you are today, kind of making a benchmark, a baseline, creating this blueprint, and then adjusting your risk and return expectations and asset allocation along the way.
You have talked about in the past that the plan is a living document, right? It's not a one and done. And that's a great example of making sure that that document is a living document, always looking at the changes that happen in your life and the needs. All right, what's number 3?
Number 3 is diversification, which certainly is directly related to number 2. But we see a lot of what we call concentration risk in portfolios, particularly either someone inherited a stock that they got from their grandmother, and we see it a lot of times, and they don't want to sell it, or someone owns a business, typically a small to medium-sized business, and maybe 90% of their net worth is tied up in that. And so they're exposed to what we call concentration risk, where if the wrong thing happened, it can blow up that one business. And it's been many years now, but at one time, Johnson & Johnson, there was a Tylenol scare where some crazy person, spiked bottles of Tylenol. And, if you own that stock, it went down significantly. Now, of course, it'll come back. But if you don't have enough diversification in your portfolio, you're going to miss certain opportunities and expose yourself to undue risk. So whether it's through asset allocation funds or just building an individual custom portfolio based on whatever the fact pattern is, you want to make sure you have proper diversification. And that way, when you have these incidents of volatility in the market, which have always been there, 2017 was kind of an aberration in its lack of volatility, but in most cases, you're going to have 1 or 2 10% downside movements in the market on an annual basis. So proper diversification really protects you and will make it easier for you to stay committed to your long-term goals and objectives when you're having some bumps in the market, because the worst thing you can do is sell out because you freak out, after the market's dropped, because then you'll probably get back in after it's gone back up and create a really bad cycle of events for yourself.
I'm going to quote you on that, Russell, from here on out, the get out when you freak out. That was absolutely freaking awesome. Okay, inflation. Now, this is number 4. So we've talked about happiness, risk, return, diversification. Considering inflation is something I don't believe people truly grasp the impact of inflation. How do you make sure that that's part of your financial plan?
Well, you, again, make sure that's part of your financial plan by really coordinating with number 3, diversification, because inflation is a beast. And if you think about 3% inflation, that doesn't sound very bad, but what does that mean? That means in 24 years, price of things will double. And, there have been a lot of markers more recently that say inflation is really low. But I don't know about you. You see gas prices are still pretty volatile. And if you go to the grocery store or, many restaurants, the prices maybe haven't changed that much, but the portion size has gotten smaller. So you're still paying more for less. And that, in effect, is inflation, even though the price hasn't technically been raised. But a lot of people, if they tend to be quote unquote safe, they're not going to really earn net returns, net gains after factoring in the cost of living and inflation, and then of course paying income taxes. So you want to factor in pre-tax and post-tax investments like 401ks, IRAs are pre-tax, but they're taxable in the end. Roth IRA or 401k, Roth 401k are after tax, tax-free when you take them out, and then other instruments are somewhere in between. So you want to look at the inflation and the tax impact on all your investments. And again, even with the type of investments from how they act versus inflation and taxes, you want to have proper diversification in that too. So you don't, we see people that want to put all their money in real estate because they know it, or they put all their money in their business, or put all their money in X, fill in the blank. Anytime you do that, you're going to create excess risk and potentially inflation hedging issues for yourself. So, but you got to understand that prices are going to go up. And if you're no longer working and not getting raises due to that, then your portfolio has to be structured so that it can offset the impact of inflation, so you can maintain your standard of living in what's possibly 30, even 40 years of retirement. And I was talking to a client yesterday whose wife's great-grandmother's 107 years old. And I'm like, I don't know if I ever want to be 107, but maybe if I'm 106, I want to be 107. But, you can live longer in retirement than you worked in this day and age. So you got to consider inflation.
The next one is the one thing about financial planning, Russell, that I've never really understood, how you as a financial services professional and a certified financial planning professional are able to plan for or react when this happens, which is unforeseen events. Now, this doesn't necessarily have to be a negative event. It could be grandchild being born. It could be, somebody getting married. How do you help people plan in their financial plan for those unforeseen events?
Well, really, as you said, it can be positive or negative, but the gist of it is you want to have 3 to 6 months of your net expenses. We call them living expenses, and we look at expenses by taxes, debt service and liabilities, savings, charitable gifts, and living expenses. So we break them into 5 general categories. But I have this saying: you do your plan, then life happens. So you adjust your plan. And it's never what you thought it was going to be. It's going to be something else. But if you have an adequate emergency reserve, you can take advantage of these unforeseen opportunities, or you can protect yourself against these unforeseen issues. And whether it's a unforeseen medical emergency that your insurance doesn't cover, or whether you have some insurance that doesn't cover your heating and air conditioning going out, or your car breaks down, you have to get a new car. All these things can be a drain on your cash or leave you subject to having borrowing at high rates because you don't have the capability to fund it on your own. So we like to create mechanisms where if you have a short-term incident, you have money on hand to address that, and you can make arrangements to use a line of credit or something like that, but it would be done from a strategic decision standpoint because that makes more sense, not because you don't have a choice. So preparing for unforeseen events means you can respond strategically and not have to react to some knee-jerk tactic that you select. You see if you're driving around, there's title this, title pawn. There's all kinds of different places where they're happy to loan you money against your title. And why is that? That's because they have the advantage and they charge these people, high interest rates because they don't have options. So being prepared for unforeseen events means you have options. And that's very important that you be prepared, and it's better to be prepared and not need it. That old saying, it's better to have it and not need it than to need it and not have it is very true.
I'm going to recap the first couple ones here, and then you've already led us into number 6. So the first one was investing in happiness. Number 2, risk and return. 3, diversification. 4, consider inflation. Number 5, unforeseen events. Now, number 6 is unplanned investments or incorrect buying. And I think you just, with that statement that you just said at the end there with, if you don't have a good plan, then the plan is basically going to force you to do things like title pawning and things like that. But there are other unplanned investments or things that you have experienced that you've heard clients say, well, John down the street invested in this. How do you help them overcome knee-jerk reactions, herd mentality, stuff like that?
Well, really, you can't always do that, but our best focus is on education and using historic metrics to share with clients. And unplanned investments could, like we talked about with unforeseen events, could be an opportunity, but you want to see how does that opportunity fit in your overall scheme, and do you need to do something? Because if it's an opportunity to invest in a piece of real estate or some startup company, there's going to be risk or lack of liquidity in that. And if you're already on track with your plan, you really have to weigh, does it make sense to tie up your money or risk your money in a venture like that? It's really just about the fact pattern, the timeline, and do you have the ability and the risk tolerance to leave it alone if it gets rocky. And you really do have to understand the facts. I think it was Reagan that said trust but verify. You want to understand the facts. And really, we have a philosophy that if we can't explain it where you understand it, then don't do it. Wait until we get there. And also, if there's deadline pressure where you just immediately have to make a decision, walk away. Incorrect buying is more either you're buying things just fundamentally because you want to without understanding the facts, or it could be more like what we talked about earlier. The market, and I'm not quoting exact figures here, so I'm being more philosophical, but say the market's averaged 8 or 9% based on the S&P over long periods of years. Well, I believe it's Dalbar, if you wanted to look it up. They've got statistical research that shows, well, the average client may have earned somewhere between 2.5% and 4% because they're always buying incorrectly. They typically sell after it's gone down and buy after it's gone back up, or as you referenced, they just buy it because their coworker did it or their friend without any fundamental reference to how does it fit into their overall picture. And really, rocket science is not the metric that we're trying to use here. It's common sense and taking your time. And the old axiom, if it sounds too good to be true, it usually is. Mm-hmm. Greed is a powerful thing, and desire to have nice things. And all those factors can cause you to buy incorrectly or participate in unplanned investments that often don't turn out as planned.
Right. Now, number 7 is one of the cornerstones of financial planning, which is it was talking about save first and then spend, not vice versa. Now, that's something that I know we as Americans really, really struggle with. How do you help with your education process to help people pay themselves first with this first save, then spend mentality?
Well, again, this is not rocket science, but there's really a couple ways. The most common way in America now is the 401k, because we're paying ourselves first. And, philosophically, we believe that you should pay yourself first. You are investing your life in this work to generate revenue for yourself and your family. But one day you're not going to want or be able to do that. And so you have to harvest along the way some of your sustenance, and we call it saving to spend. A lot of people will have good intention and try and save, or they will save into a checking account or credit union, whatever it may be, but then they spend it on many things. Sometimes it could just be Starbucks every day on the way to work, or McDonald's or something like that. Not always a big ticket item, but that's like death by 1,000 cuts. If you add up the annual cost of these things, it really can make a negative impact on your retirement. But when you're paying yourself first through a 401k, you're putting it somewhere where it's a little bit more difficult to get. And if you're doing traditional 401k, Uncle Sam's helping you. And then you invest it in an appropriate target date fund based on your age and time horizon and all those things, then that actually can accrue quite nicely. So we show people, particularly younger people, how with a relatively small investment on their part that they do consistently and stick with, they can create over $1 million of accumulation if they just stick with it. And if they change jobs, what people tend to do several times during their working years anymore, don't cash it out. Because if you cash it out every time, it'll never amount to anything. But if you roll it over each time, it can still amount to a very nice and tidy sum. So that's really what we call the qualified money, meaning pre-tax. If you're just talking about savings after tax money, so after your 401k and you pay your bills, you still have money left over, we like to get clients to set up a systematic savings plan, which we call a PIP. And that's just PIP, personal investment plan. So it's nothing complicated. But that's where we open an account and an asset allocation appropriate for the individual or couple. And then every month they're putting in money. And it doesn't have to be a ton of money. You start where you can. And then as you get raises and or pay off things, you add to it. And even if it's only $50 a month, you're starting something, and then you raise it. And we have people that raise and lower these all the time based on their life circumstances. And then you're creating more of a balanced approach where you have pre-tax 401k money. You're going to have that emergency reserve account, this cash that we talked about earlier, and you'll have this after-tax non-qualified account that you're adding to monthly as well. So by doing these monthly, you're not having to write large checks to save, because there always seems to be an impediment to that. And you're also kind of reducing risk in the market because you're buying in over time. There's a concept called dollar cost averaging, which allows you to buy in, say, 12 times a year instead of one time a year, and the market goes up, the market goes down. So your average cost of entering the market will be reduced. And that's no guarantee of returns, of course, but it can reduce your risk, and risk is what scares people a lot. And it kind of removes the need for us to be disciplined, because we don't tend to do that. And, I'm segueing to number 8, a disciplined approach.
Keep going. I follow that thought, brother. I love where you're going.
Yeah. So by doing things like that, 401k and this personal investment plan, or PIP for short, you have created a disciplined saving plan, and you have your emergency reserve. So if something happens where you need some money, you don't have to disrupt your PIP by taking money out and hopefully paying capital gains taxes because it's gone up. You can leave it alone to continue to grow, or you don't have to take a hardship withdrawal from your 401k or a loan, where even though you're paying interest to yourself by borrowing from the 401k, if the market goes up, say you're paying yourself 5% interest, but the market goes up 10, you missed out on that 5%. That's called opportunity cost, and it's real. So, and then the discipline approach also is about understanding the difference between wants and needs. If you want to buy something but you don't need it, and you're not on track for your retirement, kids' college, or buying that second home in 20 years, or the new car, whatever it happens to be, have the discipline not to buy it because you want it. Only buy it if you need it. And, there's really needs, wants, and dreams. And Americans have trouble differentiating because we don't like delayed gratification. So you have to have the discipline to save, but you also have to have the discipline not to spend unless you need it, not just because you want it. And one of the beauties of savings programs is if you've got your 401k going properly, you've got your emergency reserve, and you have your personal investment plan, all 3 of those are going and hitting on all cylinders, and you still have money left over, you can spend that on things that you want, not just things that you need. But we have a crazy misunderstanding of whether we need it or want it. And, people should think that through every time before they make these impulse purchases.
Russell, thank you so much for going through these 8 basic principles of financial planning. I'm going to do a quick review here, and then we'll finish it out. Number 1, investing in happiness. Number 2, risk and return. 3, diversification. 4, consider inflation. Number 5, unforeseen events. Number 6, unplanned investments, incorrect buying. Number 7, first save and spend, and then a disciplined approach. If somebody is not working with a certified financial planning professional, what should they be looking for in their relationship with their financial advisor? And if they're not talking about these 8 things, what should they do?
Well, they need to do their research. I mean, it really is, I guess the most clear thing is understanding that the person you're working with has your best interest first. First and foremost. I think people are either ethical or they're not, and don't be afraid to ask the hard question. If you feel like you're being sold, say so. Just have that candid conversation with the person that you're working with. And I think really knowing what you want is really critical too, because if you don't know what you want or need or where you're trying to go, how can you get there? You're going to be much more vulnerable to being sold something. So you have to know what you want and what it takes to get there, and then decide whether you're willing to pay that price or adjust your dream. And then I'd say if you're married, communicate, often and clearly with your spouse, because that's one of the biggest impediments to good relationships is we don't communicate these fears and or interest in opportunities, or determine if we have similar goals and objectives and we're kindred spirits or not. And so I think it's really about communicating effectively within your family unit, but then also communicating effectively with your financial advisor. And if it becomes clear, I think, if they have your best interest at heart or not. And, one of the things we focus on is strategic decision making made in a proactive manner. And we reach out to our clients in a proactive manner. So their financial advisors should be doing so too. And if they're not, they should pause and really consider whether they should look for someone else. And that doesn't mean that person is not good at what they do, meaning the financial advisor. But if they're not reaching out to you in a proactive manner, staying in touch other than when they're trying to sell you something, you need to revisit that. And, not everybody needs to work with a financial advisor. If someone's just spot on and they have the time and the interest, do the research. And then, we like to say yes and no are both the right answer. Just educate yourself appropriately and then make a decision. Do not procrastinate, because procrastination is the biggest killer. And the path to where is paved with good intentions. So we have to execute. And that's why we tell people we're going to become their financial planning drill sergeant, because we're going to provide that discipline, that unvarnished truth, to tell them the things they need to hear that they sometimes will not want to tell themselves. And so we bring discipline to the equation for those people that are interested in that, who don't have it themselves.
Well, Russell, thank you so much for everything that you do for your clients and for your community, and thank you for your thought leadership.
Thank you, Matt. I appreciate your time today and look forward to the next time.
If you have not subscribed to the podcast, click that subscribe now button below. That way, every time Russell and Carl come out with a new podcast, it'll show up directly on your listening device. So for everybody at Jacobs Coolidge and Company, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs Coolidge and Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.